Hi everyone. In this particular session, I want to look at the assignment for MAC4865. So I'm just grabbing my calculator and everything else so that I can guide you, right? So this particular assignment, I'm going to make it public so that everyone can be assisted when it comes to the assignment. Okay. So let's start with the multiple choice. And we have multiple choice question up until question 5. All right. So I'll assist only with the calculations and I'll guide on the theory. All right. Now, the first question reads, the following financial information relates to Amsterdam. The dividend yield is 10%. Earnings per share is 150 cents, which is R1.50. Price earnings, which means the price over the earnings, gives you 7, right? Price earnings, PE ratio is 7. So the issue here is you need to know what the dividend yield formula is, right? So you know the dividend yield is an inverse, right? Is the inverse of the, what do you call it? Is the inverse of the dividend over the price, right? So the dividend yield, right, will then be dividend per share over share price. Because if you say share price over dividend, what we are trying to see is how many times does the dividend go into the share price. But in this case, we are saying dividend yield, which is dy, sorry, on the script now. Right, it's dividend per share over share price, right? So dividend per share, in this case, you are given earnings per share, then you are given price earnings ratio. And what they want is to get the dividend per share. So you're looking for X, right, which is the dividend per share, over the share price, which is Y, but you're not given the share price, right? But you are given the earnings per share, right? So EPS is R1.50, right? And then the price earnings is 7, right? So to get the earnings, right? This is price over earnings, right? So to get the price, you would now say share price is equal to EPS multiplied by the PE ratio, right? Of which this would be 150, right? Multiplied by 7, and this gives us the 10.5. Should be 10.5. Yeah, gives us 10.5, right? There we are. So dividend yield, we've been told that it sits at 10%, right? So we will now say 0.1 is equal to X over 10.5, right? So we multiply both sides by 10.5. Cancel here. Therefore, x is equal to 10.5 times 0.1, which gives us 1.05. If we have such an answer, then that answer is at B. All right. Then from there we move on. So 1 is B. Okay. 1.2, Budapest Limited is based in country H, where the functional currency is the H dollar. Some of the Budapest Limited suppliers are based in the UK, and they invoice Budapest Limited in British pounds. Therefore, the finance department of Budapest Limited monitors the exchange rate between the H dollar and the GBP, and they use the interest rate parity theory to estimate the likely exchange rate, right? The current spot rate is H dollar to GBP is 37.5, which means the H dollar is stronger than the pound. And the expected interest rate in the UK and H is 6 and 10 respectively. So the H is your home country, right? H is your home country, while is the British pound, while is UK or England is the foreign country. So in this case, remember to calculate the interest rate parity theory, or the exchange rate according to the interest rate parity theory. We say this is equal to 1 plus IB, right, over 1 plus IA, interest for country B multiplied by the spot rate, right? Okay, so they want here the future spot rate in 1 year's time using the interest rate parity theory. So this would be 1 plus 0.06, right, over 1 plus 0.10 times 37.5. So you see that the interest rate here is higher than the one here. So it's obvious that this rate is going to move towards Great Britain. So the rate must be lower than this. If you see it higher than this, then there is a problem. So in other words, you can actually say the answer is at A, because the higher the interest rate, the more the inflation, and therefore it means that this one has got a better currency in terms of the exchange rate movement. So 37.5 times 1.06 divided by 1.1, this would give you 36.14. Okay. Then that's your answer, which is at A. Okay. All right. So now this assignment, today's the 21st. This assignment is due on the 25th. So there is time for you to work on this, which is why I'm recording it now so that you guys can have ample time to actually work on this particular assignment. All right. Lisbon Limited is based in country P, where the functional currency is the P dollar. Lisbon Limited sells some products in various European countries denominated in euro. Sales in 1 year's time are expected to be 250,000 euros. The current spot rate is that, okay? Interest rate in Europe is 5 and 11 respectively. Okay. The financial director, whatever, what is the expected exchange rate in 1 year's time? So again, we are using the same interest rate parity theory, the formula you know now, right? So here it's 9.7 multiplied by 1.05 divided by 1.11. Am I right here? 5% and 11% respectively, and therefore it should be lower than 9.7. Okay. So that'll be 9.7 times 1.05 divided by 1.1 gives us 9.18. Okay. So the answer is at B. What is the expected value when translated into P dollars? What is the expected value of euro sales? But now, is it current rate or future rate? So let's use the current rate, which is 9.7, right? So that will multiply because the euro is less stronger here. So that's 250 times 9.70, which will give us 9.7, which will give us 2425, like that. Okay. So again, you see here, which means they are looking for the future rate. I think whosoever designed this question may have overlooked the fact that he must have stated the future rate, not the current rate. And in this case, it didn't even state between future rate or current rate. So we'll multiply 250,000 times 9.18, then we get 2,295,000. So I don't understand here what went wrong. No, I think Campoano was not thinking straight here. Okay. So, okay, these are euros. Okay. So since these are euros, right, it means we now have to divide 9.7 here, not multiply. My apologies for that. So 250 divided by 9.7. But don't they want euros? Or they want P dollars. So into P dollars, this gives us 25,773.20. Yes, so the answer is at A. If we use the future rate, it would be higher, which will give us 27,260 something. So the answer is at A, which is this one. All right. So we divide, we do not multiply. My apologies for that particular mistake. All right. Then we move on to question 1.4, right? 1.4 reads, Edinburgh Limited shares currently sell at 16 Rand 50. Edinburgh Limited plans to make a rights issue of one rights issue for every 4 existing shares, which is 1 divided by 4. So what is the theoretical X rights price? Okay, so here we need to know the formula for the TAP, theoretical X rights price, right? theoretical X rights price. Sorry that I've been calculating with without stopping the sharing here. My apologies, but I think you did hear the how we do it. Okay. So now if we want to calculate TAP, right? It's a simple formula that we need to use there, right? Now we calculate TAP as 1 over n plus 1, right? Multiplied by the it's n plus cum right price, right? And plus issue price. Okay, so this is the old. So in other words, we are saying 1 over 4 plus 1, right? Which is 5, multiplied by 4 times the old price that was there, which is, when we say come right price, it means that before the rights issue has been issued, right? Before the rights issue has been, all right. So what we do, I'm checking that MAC 865 because I'm not sharing now so that I can read. Okay, so the price was 13. But the issue price now is currently sell at 16 and 50. 16 and 50 plus here the theoretical the issue price is 13, right? Plus 13. Now an easier way would be to say okay, let me calculate first, then we get the answer, and I'll show you another way which is easier, or the easiest. 4 times 1650 plus 13 divided by 5 gives us 15.80, right? 15.80, which is at C. Alternatively, you can just say there were 4 shares issued, which were costing 16.50, and plus 1 share costing 13 rand, and now you've got 5 shares. It's simple as that. So it's now 4 times 16.5 plus 13 divided by 5 gives us 1580. Simple. So that's how you calculate it. Okay. Then from there, we have 1.5 question. 1.5. Preg Limited required funding for a new project and is considering a rights issue to raise the required 36 million. Preg Limited currently has Preg Limited currently has 50 million 1 rand shares in issue, trading at 9 rand. The directors believe that a discount of 20% will be required to encourage investors to take up their rights. What should be the terms of the rights issue, right? So we've got 50 million shares, right, trading at 9 rand. Okay, so $50 million, okay. $50 million times 9, which gives us 450 million. 450 million. This is the value of the shares. But we want 36 million, right? We want 36 million. This is the value that we want. And a discount of 20%, it means that we multiply it 9 times 0.8, which will then give us a new value, 9 times 0.8, which gives us 7.2. If we get 7.2 here, right, times X, which is the number of shares that we need, should be able to give us this amount, 336 million, I mean. So what is X? We divide by 7.2, which means we need how many shares? 36 million divided by 7.2 gives us 5 million, right? 5 million, right, is a ratio of 50 million shares currently in issue. So it's 1:10, and I believe we do have that on C, right? We do have that on C, right? 1.6 reads, the following information related to ROM Limited. Current cost of equity is 10%, and geared cost of equity is 7%, right? WACC is 6.7, market value of equity is 80, debt is 15, tax rate is 27, right? ROM is planning to raise 10 million of debt to repurchase shares, right? So it means that the ratio becomes 70:25. According to M&M theory with tax, what would the WACC move to? So the best here is to first find the cost of debt here, okay? Because we have a WACC of 6.7, right? So I'm going to erase this, and I'm going to throw this one away. It's also no longer useful. Okay. So we have 7, okay, WACC is equal to value of equity times cost of equity, right, over, okay, let's do this, plus value of debt multiplied by cost of debt multiplied by 1 minus T, right, which means after tax, right, all over the total value of company, right? So here we say 80 multiplied by 7, right? Am I right? The ungeared cost of equity is 7, right? Plus 15 times X, right? All over, which is after tax, all over 95 gives us what? Is it 6.7? 6.7, which is the WACC, right? So if we calculate this, let's take 95 here, right? So 95 multiplied by 6.7 gives us 636.5. 636.5 is equal to 80 times 7 gives us 567 plus 15x, right? So this comes this side, we subtract, right? Gives us 69.5 is equal to 15x, right? So we divide by 15, it gives us 4.63 is equal to x. But this is after tax, right? And our tax rate sits at 27%, right? So to get the debt cost before tax, we divide this by, that's 73, right? Yeah, 27 from 100, right? 100, which gives us 73. My apologies, excuse me. So 4.63 divided by 0.73 gives us 6.34. This is the debt, the cost of debt before tax. Okay. Now, after we get the cost of debt before tax, that's why it's 3 marks, because it's a nice calculation, that one, right? So now things have changed. It's now using the same formula, 70 times 7, right? Plus, now it's the value of debt is now 25, right? Because nothing changes in terms of the total, it's still 95, right? But what changes is up here, right? So this is still, it's going to be 4.63 because the debt has not changed. The tax rate has not changed. So it's 70 times 7 plus 25 times 4.63, right? Divided by 95. This will give us a work of 6.38. Okay, and I believe we do have that sorry, we do have that. Okay, so this gives us 6.38, and here the answers we have is 6.5 to 6.65. So what I'll do is to get the nearest, of which the nearest here is 6.52. That would be your answer, which is at A. Right. Okay. Then the next one is 1.7, then we'll have 1.8, right? London Limited has 25 million shares in issue, trading at 12 Rand per share. The directors have decided a a 1 for 5 scrip dividend to shareholders, what would the company's share price be after the scrip dividend has been issued? So in other words, the scrip dividend, there's no cash movement, right? So we are saying 1/5 times 25 mil gives us 5 million shares of zero value. So in total, you now have 30 million shares, right? But the worth of the shares is still 25 times 12 million, right? 25 million times 12, which gives us 300 million divided by now 30, which gives us 10 rand per share. So that's your answer there, which is a B. So it's 2 marks. It's an easy calculation. Right. Paris is a French company which is a wholly owned subsidiary of Berlin, a company resident in Germany. Paris borrows 1.2 pounds from Berlin, paying a market rate of interest of 7% per annum, right? Paris had to borrow from Berlin as its French bankers were not prepared to lend it more than 900,000 pounds. With reference to thin capitalization, how much interest of borrowings is Paris likely to have relieved for tax purposes, right? So we only relieve on what is allowed, right? Not on the surplus. They will be relieved on what is allowed. So it would be 900 times 7%, right? Okay. You just need to calculate there. So that's 0.07 times 9. Oh, how come it's given me? Okay, so I took so it's, okay, 63,000. This is what will be allowed. Then the surplus is the 21,000. So the answer is at D. Okay. Now we go to question 2, right? So allow me to share the screen, then we can discuss this. All right. So this reads, PIY Limited is a company that produces frozen do-it-yourself, or rather pizza, eat-yourself-at-home pizzas. The company stands 24 years ago as a family business and has rapidly grown ever since. The company was listed on the JSE in 2023. Pi Limited has 60 million warrant shares issued, currently trading at 15 Rand per share. You've been newly appointed as the financial manager of Pi Limited, having completed your university studies recently. The board still comprises mostly of the original family members that started the company. Since you have my battery, sorry, allow me just to connect to the charger. will be encounter challenges. Okay, let me pause. Since the company listed, the administrative, legal, and external audit, external reporting burden has grown significantly where the board is unfamiliar with what is expected of them. The managing director, Mr. Glovani, has been confronted with several issues during the last couple of months where he has asked for your assistance. The issues include, in an unfortunate health and safety, okay, before we go there, let's read what is required, then we'll read the rest. Briefly explain the aspects of the three categories of disclosures required by the GRI, right? So the GRI requires you to report on financial, environmental, and social matters, right? Those three. So, as a corporate citizen, you're supposed to disclose your financial issues, right? Which is financial reporting. Then now the environmental, now we have ESG reporting, environmental, social, and governance. But when we are looking at GRI, it does not speak of governance. It speaks of environmental, social, and financial, right? Only those three. Okay, so you just need to discuss them and expand those, right? Explain what gearing is and discuss the type of funding that could be raised without increasing the gearing ratio. So gearing is the extent to which an organization finances itself from external finance or from debt finance, right? So a company is described to be highly geared when its debt is high and lowly geared when its debt is low. So now you need to discuss the type of funding, like issue of shares, right? Um, rights issues of shares also do not increase gearing, right? You need to speak of retained earnings or then you can also look at venture capital finance. It does not increase debt. Private equity finance does not increase debt. Okay. Explain what a scrip dividend is and discuss the advantages of a scrip dividend. So, a scrip dividend is a dividend that is issued free, that is uh, issued in exchange of shares. So instead of the shareholders receiving cash, they receive additional shares, right? They receive additional shares in form of their dividend, right? So the advantages are during the time you want to distribute your dividend, where you have a scrip dividend, it may seem as if you've declared a low dividend per share, but investors have more shares now to receive that little on, so that it appears little, but yet they're receiving a lot of money, and many other advantages you can think of as well, right? Calculate what Pi's Limited's share price will be after a scrip dividend, right, of 1 for 4 shares scrip dividend.